Financial Reporting Through the Lens of a Property Casualty Actuary. Chapter 19, Part 4, R2. The RBC charge for asset risk associated with equity investments, R2. R2 includes the charge for risk associated with equity investments in the following: 1. Affiliated investments, 2. Unaffiliated stocks, 3. Real estate, 4. Schedule BA assets, 5. Miscellaneous assets, including receivables for securities, aggregate write-ins for invested assets, and derivatives. 6. Replication or synthetic asset transactions and mandatory convertible securities. Typically, investments in unaffiliated stocks and Schedule BA assets, as well as the asset concentration RBC charge, represent most of the risk charge within R2 for property casualty insurers. As discussed for R0, there is an RBC charge for the ownership of common stock in insurance affiliates, which includes an R2 component. This gets rolled up with the unaffiliated stocks component of the RBC formula. Additionally, for R1, half of the RBC charge for replication transactions and mandatorily convertible securities listed above as Item 6 is applied to R2. Similarly, there is an additional charge for asset concentration in the 10 largest issuers for each type of equity investment. The calculation is performed as described within the previous section of this chapter covering the asset risk fixed income, or R1, component. We will continue by providing a brief discussion of the charges for the different types of equity investments, items 1 through 6. Affiliated investments. The following list includes the different categories of affiliated investments included in R2, which can be described generally as affiliated entities not subject to RBC, other than alien affiliates. Investment affiliates, holding companies, upstream affiliates, or parents, property and casualty insurance affiliates not subject to RBC, life insurance affiliates not subject to RBC, health insurance affiliates not subject to RBC, and other affiliates. The R2 charge for investments in insurance affiliates not subject to RBC is calculated by multiplying a factor by the book-adjusted carrying value of the common and preferred stock of those affiliates. Investment affiliates. According to the NAIC RBC instructions, an investment affiliate is an affiliate that exists only to invest the funds of the parent company. The term investment affiliate is strictly defined in the annual statement instructions as any affiliate, other than a holding company, engaged or organized primarily to engage in the ownership and management of investments for the insurer, not including any broker-dealer or a money management fund managing funds other than those of the parent company. In other words, the RBC charge for an investment affiliate is essentially the same as it would be if the reporting entity held the assets directly. For example, if the reporting entity owned a subsidiary that managed $1 billion of its investments in common stock, then the RBC charge for that entity would be computed based on the $1 billion common stock portfolio. If the charge for these investments would have been $10 million if the reporting entity owned the stock directly, then the charge for the investment affiliate would also be $10 million. If the entity only owned 60% of the investment affiliate, then the RBC charge would be $6 million, which is 0.6 times 10 million. The RBC charge for an investment in an investment affiliate is 0.225 times the carrying value of the common and preferred stock. Holding companies. For investment in a holding company, the RBC charge is 0.225 times the holding company value in excess of the carrying value, i.e., holding company value minus carrying value, for indirectly owned insurance affiliates. Let's use an example to illustrate this calculation. In this example, we will use another fictional company named Reporting Entity Insurance Company, REIC. Assume REIC purchased 100% of the shares in a holding company called HC Company in 2018. Also assume that HC Company has the following assets on its December 31, 2018 balance sheet, as illustrated in Table 83. U.S. Sub Life Insurance Company, U.S. Sub Property Casualty Insurance Company, and U.K. Sub Property Casualty Insurance Company are directly owned by H.C. Company and indirectly owned by REIC as a result of REIC's ownership of H.C. Recall that the book or adjusted carrying value is used in computing the R0 charge. The carrying value of an indirectly owned insurance subsidiary will depend on the carrying value of the holding company and percentage of the holding company carrying value that the subsidiary represents. Let's continue our example to illustrate. Assume that REIC carried HC Company on its annual statement at year-end 2018 at a value of $55 million, which is equal to the market value of the shares. Of this amount, 10%, or $5.5 million, would represent the carrying value of U.S. Sub Life Insurance Company for purposes of determining the R0 charge in REIC's RBC calculation. Similarly, $16.5 million, or 0.3 times $55 million, would be the carrying value for U.S. Sub Property Casualty Insurance Company, and $11 million is the value for the alien insurer, UK Sub Property Casualty Insurance Company. If REIC had only purchased, for example, 66% of the shares of HC Company, each carrying value would be adjusted by REIC's ownership interest of 66%. The corresponding values would be $3.63 million, $10.89 million, and $7.26 million for the three subsidiaries of HC Company, respectively. Now back to our discussion of the R2 charge for investments in holding companies. The RBC charge is 0.225 times the holding company value in excess of the carrying value indirectly owned insurance affiliates calculated in R0. In our example, this would be 0.225 times 22 million, where 22 million is derived as in Table 84. Upstream affiliates, i.e. parent company. For bond investments in a parent company, the RBC charge is 0.225 times the carrying value of the common and preferred stock of the parent, regardless of whether the parent is subject to RBC. Property and casualty insurance affiliates. For P&C insurance affiliates that are not subject to RBC, including title insurers, monoline financial guarantee insurers, and monoline mortgage guarantee insurers, the RBC charge is 0.225 times the book or adjusted carrying value of the common and preferred stock. Life insurance affiliates. For life insurance affiliates that are not subject to RBC, the RBC charge is 0.225 times the book adjusted carrying value of the common stock and preferred stock. Health insurance affiliates. For health insurance affiliates that are not subject to RBC, the RBC charge is 0.225 times the book adjusted carrying value of the common stock and preferred stock. Other affiliates. Non-insurance and insurance affiliates not included elsewhere in this chapter are classified as other affiliates. The RBC charge for investments in other affiliates is 0.225 times the carrying value of the common and preferred stock. Unaffiliated stocks. The RBC charge for unaffiliated preferred stocks and hybrid investments is equal to the book or adjusted carrying value of the asset multiplied by a factor, where the factors vary based on the NAIC class. The classes for preferred stocks and hybrid securities are the same as those for bonds, as are the RBC factors, with the exception that there are no federal government guaranteed preferred stocks. The RBC charge for unaffiliated common stocks is computed separately for non-government money market funds and other admitted unaffiliated common stocks. The computation applies a specific factor to the book adjusted carrying value. The RBC factor for non-government money market funds of 0.003 is equal to that for cash, because these investments are considered to be of the same risk level. The factor applied to other common stocks is 0.15. Table 85 lists the RBC factors for various NAIC classes for preferred stocks and hybrid securities. Class 1, of the highest credit quality, has an RBC factor of 0.003. Class 2, of high credit quality, 0.01. Class 3, medium credit quality, has an RBC factor of 0.02. Class 4, low credit quality, has an RBC factor of 0.045. Class 5 of lowest credit quality has an RBC factor of 0.1. And Class 6, in or near default, has an RBC factor of 0.3. Real estate, Schedule BA, and miscellaneous assets. In general, the RBC charge for real estate investments, other long-term invested assets, as per Schedule BA, and miscellaneous assets are computed as a factor times the book or adjusted carrying value for those assets. The RBC charges for each investment are as follows: 0.1 times the book value of real estate, Annual Statement Schedule A assets. According to the NAIC RBC instructions, encumbrances have been included in the real estate base since the value of the property subject to loss would include encumbrances. 0.2 times the book value for other long-term invested assets, Annual Statement Schedule BA assets, other than collateral loans. 0.05 times the book value for aggregate write-ins for invested assets and derivatives. 0.025 times the book value for receivables for securities. R2 for fictitious. Table 86 shows the calculation of R2 for fictitious insurance company. As with the calculation of R1 for fictitious, we had to make several assumptions because only excerpts of fictitious's annual statement are included with this publication. One such assumption that is relevant to the calculation of R2 is the distribution of stock by RBC class.